Good morning, students. So this is Revathi working as a guest in commerce in the TTWRDC Rajana Switzerland. So today I am explaining about of the financial accounting. Okay. So now discuss about of the what is accounting and what are the functions of accounting and what are the systems are using in the accounting process and how to accounting process that is accounting cycle, and then next what are the concepts of accounting, and the next classification of account. So in this video I am explain all these things. So first we know the what is accounting. So in that the definition of accounting. So the accounting is defines the according to American Institute of Certified Public Accountants. American Institute of Certified Public Accountancy defines the accounting. So accounting is an art of recording, classifying and summarizing interpretation of the financial statement in a significant manner in the terms of money. So that is the accounting. Okay, so once again I repeat, according to American Institute of Certified Public Accountancy, AICPA, accounting is art of recording, classifying, summarizing interpretation of the financial statements in a significant manner in the terms of money. That is accounting. Okay, so it is a process of communicating financial information about a business and entity to users such as shareholders and managers. The communication is generally in the form of financial statements that show in the money terms the economic resources under the control of management. The art lies in selecting the information that is relevant to the user and it is reliable. Okay, so the principle of accountancy are applied to business entities, the three divisions of practical art, so named as accounting, auditing and bookkeeping. Okay, so these three aspects we are using accounting process. So it is an art of recording, classifying all the transactions in a systematical manner. That is the accounting process, and some of the functions of accounting. Okay, and the functions of accounting, the first function is accounting helps in the maintenance of bookkeeping and record keeping. Okay, so it helps in the maintenance of bookkeeping. So first of all we know the what is bookkeeping. So bookkeeping is nothing but it is a art of recording of transactions in the chronological order. It is the bookkeep. So the every transaction is first recorded in the bookkeeping. So it is a part of the accounting. Bookkeeping is a part of the accounting. So accounting have the wider scope. So it is a very less scope, bookkeeping. Okay, so it is a keeping of all the records in a systematical manner. That is the bookkeeping. Okay, so it helps in the maintenance of the bookkeeping and record keeping. And next one is the accounting helps in the collection and storage of the financial information transactions happening within the organization and financial activities happening in the organization. So which activities are happening in the organization? So the type of the all the information gathered from the accounting records only. Okay, and the next it helps in tracking of several financial information daily or monthly basis. Okay, so the tracking of the all financial information, tracking of the all the financial information, so daily wise or monthly wise, collecting the from the accounting records, and it helps the creation and documentation of financial history from the day to latest period. So up to now, so the using of the accounting process, so all the records are updated. So day to day to the latest period. So it is a creation and documentation of the all the financial history from the day to the latest period. So all the transactions are recorded in the documentary format. And the next, it helps in the formation of comprehensive financial policy for the business. So it is also helps for the forming of a financial policy for the business purpose. Okay, so these are all the main functions of the accounting process. And the next, so what are the systems? Systems are using in the accounting process. So mainly the two systems are using in the accounting process. So first one is the single entry system and the second one is the double entry system. So these systems are very useful for the entering of the all the transactions in the records. Okay, so first first we know the what is single entry system. So in the single entry system, recording of all the transactions, only some of the transactions are recorded in the single entry system. So in the which system does not follow the all the rules and principles of accounting, the system is called the single entry system. Okay, so in that single entry system we are maintaining only two accounts. In the first one is the personal account and the second one is the cash book. Only using of the single entry system we are maintaining the two accounts. So first is the personal account and the cash book only. Okay, so that's why it is called the incomplete system, the organization. So using of the single entry system we cannot find out the arithmetic accuracy of the organization. Okay, and the next, so the single entry system, some of the features. Okay, some of the features. So it is suitable for the sole proprietorship and the partnership forms only. So the single entry system only suitable for the not big organizations. So only it is suitable for the small organizations. So that is the sole traders and the partnership firms. So sole proprietorship and partnership firms are using the single entry system. Okay, and then no present rules. So using of the single entry system, no rules are there. Okay, so the particular rule is not to perform using of the single entry system. So only personal account and cash accounts are kept. Okay, so in the single entry system only the personal accounts and cash accounts are kept. So remaining accounts are not maintained while using of the single entry system. So real account and the nominal accounts are not maintained in the single entry system. Only personal account and the including of the cash account, real account, cash account are maintained in the single entry system. So it is called as an incomplete system. Okay, it is called as an incomplete system. So all transactions are not recorded. So all the transactions are not recorded. So only cash book, using of the only personal account, cash book. So in this we are not record the all the transactions. Only some of the transactions are recorded in the using of the single entry system. And the lack of uniformity is there. Okay, so lack of uniformity. And the next, personal account. So personal account is used in the single entry system while maintaining of the this system. Okay, and the collection of information from original document. So using of the when using of the single entry system, the collecting the information from the original documents only. So variations in application. So different variations are there using of the single entry system. So why? Because so it is maintained only personal account and the cash account. So different variations are using in the single entry system. And the next, profit only estimate. So it is in the single entry system we cannot ascertain all the assets and liabilities in the organization. So we can ascertain only profit of the organization or loss of the organization. So in the certain accounting period, we can calculate, we can evaluate the only profit only we can estimate, loss only we can estimate. We cannot ascertain all the assets and all the liabilities and what is the current position of the organization. We cannot find out using of the single entry system. Okay, and the true financial position cannot be ascertained. So here we are maintaining only two accounts, so that is the cash account and personal accounts. So in that we cannot record all of the transactions. So that's why, so it cannot give the a true financial position, cannot give a true financial position. And the single entry system is not approved by the tax authorities also. It is not accepted by the tax authorities also. So why? So it is only following the some of the accounts only, that is the personal account, real account. So it is not applicable for all the accounts. So it is not accepted by the tax authorities also. And the next system is double entry system. Okay, so in that, what is double entry system? So the double entry system, so which system is follow the all the rules of the accounting, that system is called the double entry system. So it is introduced by the Lucas. So the double entry system is introduced by the Lucas. So he is a father of the accounting also. Okay, and the double entry system, the equation of the double entry system, the every debit has an equal credit. Okay, so the every debit has a equal credit. So debit equals to credit. So giving of some benefit and receiving some of the benefit also, that is the double entry system. So that is the debit, every debit have a the equal credit. So according to the system, every transaction has two whole aspects, that is the one party receiving benefit and other party giving the benefit. So when we receiving something, we give something else in return. So for example, when we purchase goods for cash, we receiving goods and give cash in return. Similarly, when we sell goods on credit, goods are given and the customer becomes debtor. So this method of writing every transaction in two accounts is known as a double entry system. So the every transaction is divided into two aspects, debit and credit. So some of the advantages of the double entry system. So it provides a complete record of all business transactions, as it records both the aspects of every transactions and find the accurate fair position of the financial systems. So in that using of the double entry system, we are maintaining the all the accounts. So that is the personal account, real account and the nominal accounts. So using of the double entry system, we can find out the accurate profit and loss and accurate and fair position of the financial statement. And the next, feasibility of business management, business management. So the very important advantage is using of the double entry system. It is feasible to manage the business very easily. Okay, and the next, effortless approachability of the facts. So in that using of the double entry system, so the each and every transactions are recorded clearly. So the effort is very less. The effortless approachability of the facts, we can get the only effortless approachability of the facts. And relative study approach. So it is useful for the relative study approach for the using of the double entry system. And the next, decisive information. So in the double entry system, we are maintaining all the accounts. So the it gives the decision information also to the organization. And the next, entire transactions are report. So the every transaction is recorded in the accounting records. So the all the transactions are recorded in the according to double entry system. Next, and find the exact profit or loss. So using of the double entry system, we are maintaining all the accounts. So we can find out the all the profit and loss accounts. So debit is equals to credit. So all the debit transactions, all the credit transactions are recorded in the double entry system. So we can find the exact profit or loss. And the next, arithmetic accuracy check. Arithmetic accuracy check. So we can check the arithmetic accuracy in the using of the double entry system. Okay. So next, control over the frauds. So we can control all the frauds using of the double entry system. So in the double entry system, we are maintaining all the records. So there is no possibility to doing of the frauds. So we can control all the frauds using of the double entry system. So these are the advantages of the double entry system. Okay, so first one is the finds the accurate and fair position of the financial statement, and next, feasibility of business management, and the effortless approachability of the facts, and next, relative study approach, decisive information, entire transactions report, find exact profit or loss, arithmetic accuracy check, and control over frauds, finds the accuracy and fair position of the financial statement. So these are all the advantages of the double entry system. Okay, and the next, accounting cycle. Okay, so it is in the accounting process, the accounting cycle is very important. So in the first stage is the collection of the data. So all the source of the documents are recorded in the records, and the second one is the journal. So in the journal, all the transactions are recorded. All the transactions are recorded in the systematical manner, and it is a primary recorded in the journal in the chronological order in which such transactions take place. That is called the journal. So it is derived from the French term. So jar. So it is derived from the French term, that is jar, which means this indicates that journal is a book which record the day-to-day transactions of the business. So which record the day-to-day transactions of the business. That is the journal. So the process of recording, the transaction in general is called the writing the journal entries. After recording the transaction journal in the form of entries, they will be posted in the form of the ledger. So it is a classified manner. Hence, the journal is also termed as a books of original entry or book of prime entry. Okay, books of original entry or book of the prime entry. So this is called the journal. Okay, so entering of the entries in the journal, it is called the journalizing. Okay, so this is the second stage in the accounting cycle. So after generalization of the entries, here we are posting the entries into ledger. We are posting the entries into ledger. So in that ledger, ledger is a book which contains accounts all the transactions of the financial nature are primarily recorded in the journal. The accounts relating to individual firms. So assets, liabilities, incomes and expenses are debited and credited to journal, but all the transactions relating to one account are not found in the journal at one place. As a result of this, there is a drawback that may not find the net result of various accounts in journal. To overcome this limitation of journal, all the transactions relating to one account are posted at the one place, and the result of transactions relating to that account are found in books called the ledger. So it is may be defined as a book which contains record of all transactions permanently in a summarized and a classified form. So that is the ledger. Okay, now so after generalization of the records. So after generalization of the records, where the entries posting into ledger. So that is the third stage of the accounting cycle. And the next one is the trial balance. So after posting into ledger, we are preparing the trial balance. So what is trial balance? So it is a statement containing the balance of all ledger accounts as at any given data arranged in the form of debit and credit columns placed side by side and prepared with the object of checking the arithmetic accuracy of the ledger posting. So why we using of the trial balance? So we can checking the arithmetic accuracy of the ledger postings. The fundamental principle of double entry system of bookkeeping is that every debit has an corresponding credit and vice versa of equal amount. So therefore the total of the debit balance must equal in agreement of the trial balance. Significance that both aspects of each transaction have been recorded and that books are arithmetically correct. So if the trial balance does not agree, it suggests that there are some errors which must be detected and rectified before the final accounts can be prepared. Okay, so that is the trial balance. So while preparing of the trial balance, so it is the debit equals to credit, must be debit equals to credit, that is the trial balance. And the next, after preparation of the trial balance, we are go for the adjustments to rectify all the adjustments. Okay, in the transactions are adjusted to the from the adjustments. Okay, and the next step is the closing account and stock valuation. So calculating of the closing stock and valuation of the stock, it is the stage 6. And the next stage 7. So in the stage 7 we are preparing the final account. So final account means here profit and loss account and the balance sheet. So we are preparing the profit and loss account and the balance sheet. Using of the these all we are preparing the profit and loss account and the balance sheet. So we can get the all the information in the profit and loss account and the balance sheet. So these are the 7 stages in accounting cycle, including the accounting cycle. The first stage is the source document, and the next one is the journal, next ledger, next trial balance, next adjustments, closing account and stock valuation, and the next preparation of the final account. So these are all the 7 stages in the accounting cycle. Okay, and the next one is the accounting concepts. So these accounting concepts, it is a very important topic. So these concepts are very useful to recording of all the transactions in the accounting records. So according to this concept, the assumptions of the conditions and are based. So there are the number of accounting concepts we are maintained while recording of the entries in the accounting records. So first we discuss about of the business entity concepts. So according to these concepts, separate the business from its owner. So as far the accounting is concerned, the owner and the business are two separate entities. This will help the accountant identify the business transactions from the personal ones. So according to business entity concepts, so the proprietor is different from the business. The business and the proprietors to maintain the two separate entities. So the business is one entity and the proprietor is other entity. So all the transactions of the business are recorded in the books of business from the viewpoint of business as an entity. In case this concept is not followed, affairs of the business will be mixed with the personal transactions of the proprietor and the true picture of the business will not be known. So okay, so we are using of this concept. So this is the proprietor and the business are two entities. The business expenses are recorded in the business accounts, accounting records. The proprietor expenses are recorded in the proprietor account only. So we cannot mix the proprietor expenses to the business expenses. So if you mix, if you not follow the business entity concept, we cannot know the actual amount of the uh, true picture of the business will not be known. Okay, true picture of the business will not be known. So even the proprietor is rewarded as a creditor to the extent of the capital contributed by him of the business. So capital is recorded as a liability of the organization. Okay, so must and should follow these concepts according to entering of the transactions. So that is the business entity concept. Okay, and the next one is the money measurement concept. So according to these concepts, the only financial transactions will find a place in accounting. So only those business activities that can be expressed in monetary terms will be recorded in accounting only. So any other transactions, no matter how significant, will not find a place in the financial account. So the every transaction is measurable in only money only. That type of the transactions are only recorded in the accounting books. So the which transaction is not measurable in the money, we cannot record in the financial books. That is the money measurement concept. Okay, so according to this concept is actually one of the major drawbacks of accounting. So for example, if the company underwent a major management overhaul, this would have no effect on accounting records. So this concept is actually one of the major drawback of the accounting system. So and the next one is the going concern concept. So this going concern concept assumes that the business will continue operate identifiably. So it assumes that for the foreseeable future. So accounting is done on the assumption that the business shall have a long life and it will continue to exist until it is dissolved. It is for this reason that fixed assets are recorded at original cost and are depreciated on the basis of their expected life rather than on the basis of the market value. So it is not proper to show fixed asset in the balance sheet at the market value, as they are not intended to sold immediately. So according to going concern concept, so the business will continue to exist until it is dissolved. So it is the business is continued until until the dissolved. So up to dissolve, the business is continuing the process. So this is the going concern concept. Okay, and the next accounting period concept. So every organization according to its needs chooses a specific period of time to complete an accounting cycle. So generally the time chosen is a year. We call accounting year. The time period is mentioned in the financial statements. So even though it is assumed that the business will continue to exist for a long period, it is necessary to keep all the transactions such a way that the results are known as a frequent intervals. So according to generally adopts a 12 months a period for the measuring the income of the concern. This time is called the accounting period. So in this accounting period concepts, the every business is followed the mostly two accounting period concepts. So first is the one is the calendar year and another one is the financial year. So the calendar year starts from the January to December and the financial year starts from the April 1st to December 1st. So that is the accounting period concept. And the next cost concept. So in that cost concept, so this accounting concept states that all the assets of the firm are entered into books of accounts at the purchase price, cost of acquisition, transport, installation each in the subsequent years to the price remains the same. So minus depreciation charge. So the market price of the asset is not taken into consideration. So in that using of the account cost concept, according to this concept, an asset is recorded in the books of all the price paid in acquire it, and this cost is the basis for all the subsequent accounting for the assets. So assets are not recorded at market values because these values are keep on changing with changes in prices level from time to time. That is the cost concept. Okay, and the next, dual aspect concepts. So dual aspect concept basis a principle of accounting. It is a very important concept for the accounting system. So it is the heart and soul of the accounting, and it basically is one of the golden rules of accounting. For every credit there must be a corresponding debit. So every transaction we record must have twofold effect. That is, it will be recorded in two places. This is the core concept of the double entry system of accounting. So according to dual aspect concept, every transaction is follow the debit is equals to credit. That is the dual aspect concept. So we are receiving the some benefit compulsory, we are giving to the some other benefit to the other person. So dual aspect concept, that is the dual aspect concept. So every credit must be corresponding a debit amount. So debit equals to credit. That is the dual aspect concept. And the next one is the realization concept. So in the realization concept, revenue is only recognized when it is realized. So now revenue is the cash inflow for a business arising from the sale of goods or services, and we assume this revenue is realized only when it is legally arises to be received. So when the revenue is received, so it is on the time only we are receiving the revenue. That is the realization concept. And so in simple terms, the profit earned will be recorded when it is actually earned. Okay, so in the simple terms, when we are receiving the profit, on the time only we are receiving the actually earned. So that is the actual earned profit. Okay, so that is the realization concepts. Okay, and the next, matching concepts. So this concept states that the revenue and the expenses of transaction should be included in the same accounting period. So to determine the income of a period, all the revenues and expenses with paid or not must be included. So according to matching concept, all the revenues and expenses are included. So not to excluded from the accounting records. That is the matching concept. Okay, so these are all the very important accounting. So these are all accounting concepts. So next one is the classification of the accounts. Okay, so the classification accounts mainly two types: personal accounts and impersonal accounts. So the first, the personal account is divided into three types. One is the natural persons accounts, artificial persons accounts, and the representative persons accounts. And the next, impersonal account, real account and the nominal account. So again, the real account is divided into two types: tangible real accounts and intangible real accounts. Okay, so these are the this is the classification of accounts. So first we discuss about of the personal account. Okay, so what is personal account? So the personal account is an account which is either directly or indirectly related to individuals, companies, firms or organizations, are known as a personal account. Okay, so a personal account an account which is directly or indirectly related to individuals, companies, firms or organizations are known as a personal account. So for example, so Shweta account, XYZ Private Limited account, capital account, prepaid account, bank account, drawing account, creditors account, outstanding account, debtors account, suppliers account, and these are all the examples of the personal account. So this including of the personal account capital. So for example, capital account. So the RAM introduced the capital of 50,000 of amount. So on that time we are debited the cash account and credited the capital. Instead of the person we are mentioning the capital account. We are mentioning the capital account. Okay, and the next, the golden rule of the personal account is debit the receiver and credit the giver. Debit the receiver and credit the giver. So Ram paid 30,000 cash to Hari. Ram paid 30. So here the example is Ram paid 30,000 cash to Hari. So here Ram is paid the cash to Hari. Okay. So Ram is paid to cash to Hari. So here Hari is the receiver. So Hari is the receiver. So Hari account data to cash account. So Hari account data to cash account. So here cash is going out. So Hari is the receiver. That's why Hari account debited. And the cash is going out. So that's why cash account credited. Okay. So this is the golden rule of the personal account. And the next one is the classification of the personal accounts: natural, artificial, and representative. Okay, so the classification of the personal accounts: natural, artificial, and representative. So in that three types. So the personal account divided into three types: natural, artificial, and the representative. So in the what is natural account? Natural personal account. So these accounts are related to human beings. These accounts are related to human beings. That is natural persons who are created by the God. They possess a physical existence. So this type of the accounts are called the natural personal account. So for example, Sam's account, Maya's account, capital account, drawings account, debtors account, creditors account, some come under the category of the natural personal accounts. Okay, and the next ones, artificial personal accounts. So in that artificial personal account, the types of the personal account is artificial personal accounts. Second among three types of personal accounts is artificial personal account. So this account is do not have a physical existence. So the artificial personal account is does not have any physical existence. However, they are recognized as person in business dealings. Most often they are legal entities created by human beings. So for example, any public or private company account, bank account, club account, insurance company account, NGO account, and the cooperative society account, each would fall under this category. So this is the artificial personal account. Okay, and the next one is the representative personal accounts. So this account is different as compared to the other two types of personal accounts, as it refers to accounts which are represent a person or group. So accounts which are representing to the person or group. So it is not directly their account, but it is a is linked to them. That is the representative personal account. And for example, outstanding expenses, prepaid expenses account, accrued income, income received in advance account, unearned income account. These are all the examples of the representative personal accounts. Okay, and the next one is the golden rule of the real account. So in the any kind of assets which is either tangible or intangible, categorized into real account. Okay, next account is real account. So in that account, the assets, so it is completely regarding about of the assets and cash. So in that two types of the accounts, two types of the assets, tangible assets, intangible assets, categorized into real account. So here tangible assets, so which asset, which is the we can see and we can touch the asset. That type of the asset is tangible assets, which we cannot see and physically touch. The type of the asset is intangible assets. So the tangible assets, example, furniture, machinery, these are all example of the tangible assets. And the intangible assets and the goodwill, copyrights, these are all example of the intangible assets. And the next, the what is the golden rule of the real account? So in the debit what comes in and credit what goes out. Okay, so debit what comes in and credit what goes out. So what comes in debit, what goes out the credit. So this is the golden rule of the real account. And the next example, Mr. Joe purchased a furniture of 75,000 for cash. So purchasing of the furniture 75,000 of the rupees. So purchasing furniture. So when we purchasing of the furniture, only furniture account debited. So cash account credited. So furniture is comes in. The asset is comes in. So that's why the furniture account is debited. So cash account is credited. Okay. So the furniture account debited and the cash is going out. So cash account credited. And the next account is a nominal account. So those accounts which are associated with incomes, gains, losses or expenses, so are known as a nominal account. So at the end of remaining balance of nominal accounts are then posted to capital account. So in these which are associated with all the incomes, gains, losses and expenses are known as an to consider as a nominal account. So at the in the nominal account, at the end of remaining balances of nominal accounts are then posted to the capital accounts. Okay, so for example, rent account, salary accounts, so these are all considered as a nominal account. Okay, so the golden rule of the nominal account, so debit all expenses and losses and credit all incomes and gains. Debit all expenses and losses and credit all incomes and gains. So this is the golden rule of the nominal account. And the next one is the paid next example is the paid 5,000 rupees in cash. Paid rent of 5,000 rupees in cash. So rent account data to cash account. Rent account data to cash account. So here rent is an expenses. So that's why it is debited. So cash is going out. So cash account credited. So here paid rent to cash. So rent account data to cash account. So rent is an expenses. That's why it is debited. So when we paying off rent, cash is going out. So as per real account, when we going out of the cash, so it is credited. So cash account credited. So rent account data to cash account. So this is the golden rule of the nominal account. And the next, so I will give the sum of the so I will give some of the transactions to you. I will explain some of the transactions to you. So the first transaction is Krishna commenced the business with cash of 50,000. So here Krishna commenced the business with a cash of 50,000. So here cash account data to capital account. The entry is cash account data to capital account. So cash is comes in. That's why according to real account, what comes in debit, what goes out credit. So cash is comes in. That's why cash account debited and the capital account credited. So Krishna is the giver here. So Krishna account credited. Okay. And the next, deposited in bank. So the bank account data to cash account. Bank account data to cash account. So when we depositing of the money, bank is the receiver. So when we depositing of the money, cash is going out. So bank is the receiver. Bank account data to cash account. Okay. So that is the entry. Bank account data to cash account. And the next entry is purchased machinery, payment made by check. Purchased machinery, payment made by check. So this is the purchasing of the machinery, payment made by check. So machinery account data to bank account. Machinery account data to bank. So when we purchasing of the machinery, we cannot debit the purchase account. Only when we purchasing of asset, the consideration of the asset only debited. So the machinery account data to. So we are payment made through the check. That's why we are created the bank account. So machinery account data to bank account. So we are created the bank account. So why we created the bank account? We are paying the money through the check. So cash is going out. That's why cash account credited. So cash or bank account credited. Okay. And the next, purchased goods for cash. Purchased goods for cash. So here purchasing of the goods for cash. So purchase account debit to cash account. So purchase, when we purchasing of the goods, purchase debit, and when we paying of the sum of the amount to the seller. So the cash account is created. So cash is going out. So as per real account, so the cash is going out. So the cash account is created. Purchase account debit to cash account. Okay. And the next, sold goods for cash. Sold goods for cash. And the next, we are selling of the goods for cash. So we here in this example, cash is we are receiving. So cash is comes in. Cash is comes in. That's why cash account debited and the sales account credited. So cash account debit to sales account. And the next, paid salary. So paid salary. So it is an expenses to the organization. So salary account debit to cash account. Salary account debit to cash account. So why we salary account debit? So it is salary is an expenses. So as per according to nominal account, all the expenses and losses are debit. All incomes and gains are credited. So that's why salary account is debited. Okay. And the next, we are paying the cash. We are paying the cash. That's why cash account credited. Okay. And the next one is the purchasing of the machinery, payment through the cash. Okay. So purchasing of the machinery account debit to cash account. So here we are purchasing of the machinery account debited. So we are paying the cash. That's why cash account credited. So these are the examples to the transactions. Okay. So we are using the three types of accounts. We are the debited and created the all the entries. So that is the personal account, real account, and the nominal account. So once again I repeat all the rules, the golden rules of accounts. So one is the personal account, real account, nominal account. So personal account is what? So in that the debit the receiver and credit the giver. Debit the receiver and credit the giver. And the next what? Real account. In that real account, so in that real account including the assets, tangible assets and the intangible assets. So what comes in debit, what goes out credit. That is the real account. Okay. What comes in debit and what goes out credit. That is the real account. And the next, nominal account. So according to nominal account, all the expenses and losses are debit. All the expenses and losses are debit. All the incomes and gains are credited. So all the incomes and gains are credited. So according to nominal account, we follow this principle. All the expenses and losses are debit. All the incomes and gains are credit. Okay. Okay. These are the classification of accounts. So according to these rules, all the entries are entered in the accounting books. So this is very useful for you. So based on these principles, all the entries are entered in the accounting records. So girls, thank you for watching. So I hope this video is very helpful to you. So all the students, all the best.